When will he pay taxes?
Well, good question, Whitney. When would you like to pay taxes? So most of our clients like to pay the taxes second day to never, meaning they're just going to live off the interest, or they're going to keep 1031ing and just keep doing that. So the moment he takes boot, or the moment he receives actual receipt of the cash, this is when it's triggered, which is how this works. Which, by the way, it's how a 1031 works. So let's walk through how this kind of works with you. All right. So you ready? You're going to be the seller, and I'm approaching you. Okay. So Whitney, you're selling a $10 million deal. It has a zero basis. You have no debt. And if you were to sell today, you would owe, let's say, $4 million in tax. Okay. So you definitely want to do a tax deferral strategy. Okay. Because those numbers are pretty brutal if you pay the tax. So I approach you as just a regular person off the street, and I say, I'm going to buy your apartment complex, Whitney. May I give you a $2 million down payment? Would you please carry a note for $8 million? Would you do a seller carryback? And let's just say you say yes. So in that scenario, Whitney, if I give you $2 million down, how much actual receipt did you receive?
And that's yes.
Right. So you're going to owe tax on that too, because that's what it triggered. But
right.
That other $8 million is what's called a seller carryback. It's in a deferral state. You follow?
I am.
Okay. Now, what if I said I'll give you a zero down payment, Whitney? If I give you a zero down payment today and you carried a note for $10 million, hypothetically, or you wouldn't do that because in a real world, I have no skin in the game, but let's just say hypothetically you would. How much tax would you owe if I gave you a zero down payment today?
None.
Zero, right? Because you haven't received anything, and the other $10 million is in a deferral state. Now that the interest is going to happen. I'm going to pay you interest, and you're going to pay ordinary income on that interest, right? So that's how a deferred sales trust works. Here's the difference. We have this $10 million buyer lined up, and we have Whitney ready to sell, and they're about to do the transaction. But what happens is the trust jumps in right between, and it actually buys your position for $10 million in exchange for an installment note. It gives you a note. It gives you a zero down payment in exchange for the property, and immediately turns around in the same escrow and sells it to that buyer. And that buyer puts the $10 million into the trust. So if the trust bought it for $10 million and sold it for $10 million, how much gain does the trust have?
Zero.
You got it, right? And if Whitney, again, if you took a zero down payment and exchanged for the note for 10, you're in the deferral state. So how much do you owe today?
Zero.
You got it. Okay. So the buyer takes title, he's gone. So that's how it all works, right? That's why it works. It's a 1920s tax law, goes back 90 plus years. We're just creative on how we apply the law. And that's exactly what the IRS said too. This is how we know it's legal. We have thousands of business professionals across the US. But all that being said, what it does now for you as a syndicator or as the owner is it takes you out of those timelines of that 1031. Because the tax law for 1031 is IRC 1031, whereas us for IRC 453. So these are two tax deferral strategies, but they have different rules. And these rules for the 453 are much more flexible than the 1031, which means no equal or greater value, no short time period, no replacing of any debt of any kind, multiple product types, multiple investment vehicles, and I can go in and out of the trust, all tax deferred for as long as I want. And the best one, I think, for you guys has to do with depreciation. So in a 1031 exchange, the depreciation schedule travels, right? Meaning, if you take any accelerated depreciation on deals, or any depreciation for that matter, and you sell and do a 1031 exchange, that depreciation schedule goes into the next deal, meaning you need to buy a bigger property to offset it. So let's say it was a $10 million deal again, you fully depreciated it out. If you were to sell today and buy an exact $10 million deal, there's no new depreciation. It's already zero. If you buy a $25 million deal, well, now you've got an extra $15 million in depreciation, okay? But that might take on a lot of debt and a lot of risk. So some people are like, I don't know if I want to do that. Well, enter the Deferred Sales Trust. We could sell that same $10 million, put it into the trust, use $8 million to go purchase, let's say, a $25 million deal. Now there's a brand new $25 million deal amount of depreciation. It's a brand new schedule because I didn't do a 1031. I partnered with my trust to purchase this. And that's very powerful. So now you can do accelerated depreciation to offset the income everywhere. So I just said a lot there. I'm going to pause because your brain might have a few questions there.
You have just listened to another information-packed episode of Capital Gains Tax Solutions with Brett Swarts. We hope you enjoyed today's show and found it helpful. Visit capitalgainstaxsolutions.com to access the show notes and to access more resources. Don't forget to leave a review and join us again next time.